So I was reading through the latest shareholder letter from CoreWeave, and the CEO used this one phrase I just can't get out of my head. He called what's happening right now a planetary rebuild.
It does sound a bit like the tagline for a summer blockbuster, doesn't it?
It really does.
But, when you actually look at the sheer amount of concrete and copper and silicon going into the ground, he's not really exaggerating.
It sets the stage perfectly. It is Wednesday, February 18th, 2026. CoreWeave has been a public company for, just under a year now?
Yeah, the IPO was back in March of 2025.
And the stock is it's acting like it's strapped to a rocket. It's up over 30% just since the start of this year.
Which really forces the question we're here to dig into today. We've got a stack of their financial reports from late last year, earnings transcripts, some strategic announcements from January.
Right.
And the mission for this deep dive isn't to just, look at the stock price. It's to look at the plumbing underneath. Is CoreWeave actually building a sustainable utility for the AI age, or is this just a massive bubble?
Exactly.
Oh, yeah.
Is the hype real? So we're not talking about the chatbots today. We're talking about the engine room. And to understand the engine, you have to look at the fuel.
A good place to start would be the financials, the Q3 2025 numbers.
Yeah, the ones they reported back in November. So the headline number, right, was $1.36 billion in revenue for the quarter.
Which was a beat. Wall Street loved it. But the number isn't the whole story. It's the context, the growth rate.
Yeah, what was that?
It was up 134% year over year.
Wow, 134%. Now, we have to be a little careful with that number, right? CoreWeave is working from a much smaller base than, say, an Amazon or a Microsoft.
That's a very fair point.
It's just easier to double your revenue when you're starting in the low billions.
The law of large numbers hasn't hit them yet, for sure. But what's really unique here isn't just that top-line growth. It's the cost of that growth. And this is where that planetary rebuild idea really hits the balance sheet.
Okay.
If you look at the net income, they lost money. About $41 million.
8 cents a share, I think. This is the part that always throws people. How do you bring in over $1 billion in 3 months and still end up in the red? It's the infrastructure profitability paradox.
It really is. And it comes down to two main things: depreciation and just presently aggressive expansion.
The depreciation is on the chips themselves.
Exactly. They are buying H100s, Blackwells, and now the brand new Rubin chips as fast as NVIDIA can possibly make them. And those are expensive assets that lose their value incredibly fast.
Right, because depreciation isn't just an accounting trick here. A building might last 50 years. In AI, a top-of-the-line GPU might be considered old tech in 3.
Maybe even less. So that loss you see on the balance sheet reflects the reality that their hardware is, metaphorically speaking, rotting at a very, very high speed.
If you don't use that chip 24/7 from the moment you plug it in, you're losing money.
You lose. And that's precisely why the serious analysts, they tend to ignore the net loss and look at something called adjusted EBITDA.
Which was positive, massively positive. What was it, $838 million?
$838 million. And that is a huge spread. Usually, net income and EBITDA are kind of in the same ballpark. Here, they're in different zip codes.
So what does that number tell you?
It tells you that the core business, the actual act of renting out the chips, is incredibly profitable. The margin on that is 61%. So operationally, they are making money hand over fist.
But they're pouring every single cent of it, and then some, right back into buying more shovels for the gold rush.
And then some. The CapEx number was just eye-watering. They spent $1.9 billion on capital expenditures.
In 1 quarter.
1 quarter. So they spent more buying new gear than they made in revenue.
That's the definition of a land grab. They're just betting that if they build it, the demand will show up.
And so far, that bet has paid off.
Which I guess brings us to the demand side. Who is buying all this compute? The client list is basically a who's who of big tech. Microsoft, Meta, OpenAI.
Which creates this really interesting dynamic, doesn't it? Because Microsoft and Meta are technically competitors to CoreWeave.
Right, Azure is a direct rival. They build their own data centers.
And yet, Microsoft is writing enormous checks to CoreWeave.
It's the overflow problem. I kind of think of it like a hotel during the Super Bowl. Even if the Marriott has its own hotel, if it's fully booked, they have to send their VIP guests to the Hilton down the street just to keep them happy.
That's a good analogy. Now add the element of speed. Building one of these new data centers takes years.
A lot of concrete to pour.
A lot. And CoreWeave has positioned itself as the sort of agile layer on top of that. When OpenAI needs to train a new model today, they can't wait. CoreWeave has the capacity online, or at least they promise they can get it online faster than anyone else.
And that promise, that future demand, is quantified in the backlog. This was the number that just jumped off the page for me. $55.6 billion.
It's a staggering figure. $55.6 billion in contracted future revenue.
I mean, that is larger than the entire market cap of a lot of companies in the S&P 500.
And it's up 271% year over year.
Okay, but let's play devil's advocate on that backlog for a second. It's only as good as the contract that's enforcing it. These are take-or-pay contracts, right?
In theory, yes. Take-or-pay means the client, like Microsoft, pays for the capacity whether they use the chips or not. It's like a mortgage. But you have to look at the counterparty risk. I mean, what if the AI bubble bursts? Or if we see a model collapse, where the tech just stops getting better, you can bet lawyers are going to be looking for loopholes in those contracts.
Or what if inference just gets so cheap and efficient that they don't need all that compute anymore? Suddenly, $55 billion in orders starts to look like a huge liability for the clients.
Precisely. The entire business model is a bet on the idea that the demand for compute is effectively infinite.
And if it's just very, very high instead of infinite, that backlog could soften.
It could. But for right now, today, the market is treating that $55 billion as money in the bank.
And to service that bank account, they need power. This brings us back to the physical world, to that planetary rebuild. Their goal is 5 gigawatts of capacity by 2030.
And just for context for listeners, 5 gigawatts is an absurd amount of electricity. Your typical nuclear power plant produces about 1 gigawatt.
So they need the juice of 5 nuclear power plants.
Basically, yeah. Which perfectly explains the Core Scientific acquisition. That was an all-stock deal valued around $9 billion.
And Core Scientific was a Bitcoin miner.
This is where the strategy gets really clever, but also really, really difficult. They didn't buy Core Scientific for the Bitcoin rigs.
They bought it for the real estate.
Not just the real estate, they bought it for the Plex sockets. Core Scientific already had the grid connections and the land rights. That's the hard part.
But there's a technical mismatch there, isn't there? A Bitcoin mining facility and an AI training cluster are totally different animals.
Completely different. And this is the execution risk that doesn't get talked about enough. You can't just swap out a Bitcoin ASIC for an NVIDIA H100.
They run hotter.
Much, much hotter. We're talking about a power density of maybe 100 to 120 kilowatts per rack for AI. Most of those old crypto mines were designed for simple air cooling, maybe 20 or 30 kilowatts per rack.
So they have to completely gut these facilities.
Totally gut them. It's a retrofit nightmare. You have to rip out the cooling, you have to upgrade all the power distribution, reinforce the floors. It's faster than building from scratch, yes, but it is not a plug-and-play situation at all.
So that $9 billion was just the entry fee. These still have to spend billions more to convert those sites into what they call AI factories.
And they have to do it fast because that backlog is waiting.
Let's shift gears to the technology itself. Why CoreWeave? Why not just use AWS or Google Cloud? I know they market themselves as the essential cloud for AI, but is that just marketing fluff?
Actually, no. There is a real technical differentiator here, and it goes a long way to explaining their margins. It really comes down to virtualization versus bare metal.
Okay, let's break that down. Legacy clouds, like AWS, they are built to host websites and databases.
Right. And to do that efficiently, they use something called a hypervisor. It's a layer of software that basically slices up one big physical server into lots of little virtual machines.
Which is great for running Netflix or something. It's flexible.
It's super flexible, but that software layer, the hypervisor, it adds overhead. It eats up a little bit of the raw performance.
That's like a tax, a performance tax.
Thanks.
Which doesn't really matter for a website, but it matters a whole lot for AI.
It matters immensely. When you're training a trillion parameter model, that virtualization tax, as you called it, it really slows you down. CoreWeave doesn't use a hypervisor. They give clients direct access to the bare metal.
So you're talking directly to the hardware.
You're talking directly to the chip. And they built this proprietary orchestration layer on top of Kubernetes that lets them swap workloads around instantly without that heavy virtualization layer. And that is how they claim that 95% utilization rate.
95%. That's it. That seems impossible in the legacy cloud world. I thought the industry standard was closer to 40% or 50% for actual compute time.
It is. In a normal cloud, there's a lot of idle time. But CoreWeave treats its GPU clusters like a single massive supercomputer, not a server farm.
And because they can squeeze that extra 30 or 40% of work out of the exact same chip, they can charge a competitive rate and still keep their own margins really high.
That efficiency is their secret sauce. It's their real product.
So we can't really have this conversation without talking about NVIDIA.
Their rich uncle, yeah. The relationship is absolutely vital. Just last month, January 2026, we saw NVIDIA invest another $2 billion directly into CoreWeave stock.
At $87.20 a share.
Right, which kind of sets a floor on the valuation. But more importantly, it cements CoreWeave as the preferred lane for NVIDIA's latest and greatest hardware.
The reports all mention that they're committed to the new Rubin platform, the Vera CPUs.
And this is critical. In the AI arms race, getting the best chip first is 90% of the battle. By investing so heavily, NVIDIA is basically signaling to the market that CoreWeave is their chosen partner for cloud deployment. It makes CoreWeave, in effect, an extension of NVIDIA's own strategy.
But doesn't that create a massive dependency risk? I mean, if you're CoreWeave, you are entirely beholden to one supplier.
Oh, absolutely.
If NVIDIA sneezes, CoreWeave catches a cold.
A very bad cold. They have zero supply chain diversity. If NVIDIA has a manufacturing yield issue or something happens with Taiwan, CoreWeave has no product to sell. AWS has its own custom silicon. Google has its TPUs. CoreWeave is all in on Team Green.
Let's touch on the other risks. We mentioned the profitability paradox and the execution risk on those retrofits, but there's also a legal deadline coming up, March 2026.
Right, the class action lawsuit. This stems from some allegations about capacity constraints. Essentially, the suit claims that CoreWeave was promising GPU availability that they physically didn't have online yet.
Selling tickets to the concert before the stadium is even built.
That's a good way to put it. It's a common story in high-growth tech. The market seems to view this as nuisance litigation, the kind of thing that probably gets settled with a fine.
But it does highlight a real danger, doesn't it? When you're sitting on a $55 billion backlog, the pressure to deliver must be immense.
Immense. If they miss a construction deadline by even a month, that has a ripple effect that goes out to Microsoft, to OpenAI, and all the way to the end user.
And these clients aren't exactly forgiving. If ChatGPT goes down because CoreWeave missed a deadline, Satya Nadella is not going to be a happy camper.
No, he is not. And that leads directly to the concentration risk. They are serving the whales. If Microsoft decides to pull back, or if they successfully build out their own internal Maya chips to replace NVIDIA's, then a massive chunk of that backlog could just disappear.
So let's try and wrap this all up. We're looking at a company with, a $50 billion market cap, growing at triple digits, building gigawatts of power, and sitting on a backlog that seems to guarantee revenue for years.
Assuming the world doesn't change. It is the ultimate picks and shovels play for the AI gold rush. They are making a massive bet that this AI build-out isn't a phase. They think it's a permanent new utility, just like electricity or water.
And for anyone listening who's holding the stock or thinking about it, the next big check-in is just around the corner, February 26th.
Just days away. That earnings report is going to be pivotal.
What's the one thing you're going to be looking for in that report, besides the obvious revenue beat?
I'm looking at the CapEx guidance, their spending forecast. If they start to pull back on spending, it could mean they see demand softening. If they accelerate it, it means they still see infinite demand on the horizon.
And you have to watch that backlog number. If it flattens out, the whole growth story takes a hit.
Absolutely.
So here's a final thought to leave you with, and it goes right back to that planetary rebuild idea. We often think of AI as this ethereal digital thing, a cloud.
Weightless.
But CoreWeave is proving that it's actually heavy industry. It is steel and concrete and megawatts of raw power.
It's the reality check.
We have $55 billion in orders queued up. But what happens if the AI scaling laws hit a wall? What if just throwing more and more compute at the problem stops making the model smarter?
That is the multi-billion-dollar question.
You could be left with 5 gigawatts of specialized, hyper-expensive factories that are really, really good at doing math that nobody wants to pay for anymore.
If the music stops, CoreWeave is left holding a lot of very expensive, very hot hardware.
Something to think about. The next time you see a data center under construction, it's not just a building. It's a bet on the future of intelligence itself. Thanks for listening to The Deep Dive. We'll see you next time.